Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now in today's video, we are going to discuss about other comprehensive income, that is OCI, a very important concept for your CA final financial reporting. Now in this quick video, we are going to discuss all the aspects of OCI, on how it is presented, what are the items which are there in OCI, what impact does it have on items like taxes, EPS, etc. So let us get started. First of all, OCI is a pure Ind AS or an IFRS concept. It was not there in your AS. Why do you need OCI and where is it presented? Well, earlier we used to assess our statement of performance only based on the revenue profits that was earned. However, it was sometimes felt that this gives you a part of the picture, not the entire picture. Like if you have a property and you're earning rental income of that, that will go in the P&L and will impact the PAT. But at the same time, the property's value would have appreciated. And if, let us say, the property's value is appreciated, well, you would want to show this if it is permitted. You want to show this, and if it was permitted, we might have shown this into the revaluation reserve, or you invested in shares and the value of the shares appreciated, and you want to showcase that part of income as well, which may be, let's say, unrealized, not distributable, but must have been earned. And hence IFRS as well as Ind AS came up with the solution that they said that after your statement of profit and loss, you will prepare, so this is your regular statement of profit and loss. After this, at the end of the statement, after PAT, you will continue this on further into something called as other comprehensive income, or OCI, which shows the changes during the current year of certain important items which are in the nature of income but maybe not realized, maybe currently not distributable, and hence you will park these incomes, these changes, into other comprehensive incomes. So OCI comes after, in placement, after your profit and loss. After PAT, you show OCI, and your profit, if it is 100, your other comprehensive income, let us say it is 50, then your total comprehensive income will be 100 plus 50, that is 150. Now within other comprehensive income, there are two subcategories. One, there is something called as a non-reclassifiable OCI. Second is something called as reclassifiable. Non-reclassifiable means on happening of certain events, the balance in the OCI reserve will be transferred directly to retained earnings. So it is a reserve to reserve item and it will not impact your statement of profit and loss. Now a student says, how does it matter? Ultimately it is going to the reserves, yes, but it does not impact your PAT, and PAT is a very important number for a lot of ratios like the PE ratio, the net profit margin, etc. So if it goes directly to reserves, it does not really impact the PAT and is more like an appropriation item. So non-reclassifiable item is transferred directly to retained earnings on happening of certain events. What are those events? We will see. On the other hand, a reclassifiable OCI means, again happening on certain events, the balance in that reserve will directly be transferred to the statement of P&L. Maybe something like other income or other expense, and thereby impact the PAT directly. Now, which are the items to be taken where and what is the reasoning? Well, first of all, these are items which are specifically mandated by the Ind AS and you don't have any discretion over here, so you'll have to follow what is given in the standard. So when you look at a non-reclassifiable OCI, you will have something like a revaluation reserve under Ind AS 16, or a fair value reserve for equity instruments under Ind AS 109, or even a remeasurement reserve under Ind AS 19 for actual gains or losses. Now for most of these items, you would have a choice, like for revaluation reserve or fair value reserve, you can either follow the cost model, in which case there is no revaluation and the gains, if any, when realized, will go to the P&L, or if you revalue, then the gains will go in other comprehensive income. Further, for fair value reserve, for equity, you have a choice of taking FVTPL, and if not, you can take fair value through other comprehensive income. So generally, the standard says that you had a choice to take it to the profit and loss account. However, if you want to show it into a reserve, then even when it is realized, I will allow you to transfer it directly to the retained earnings without taking it to the profit and loss. Whereas when you look at a reclassifiable OCI, most of the times there was no choice earlier. That is, there are three items, the important ones, if you go to see, if we discuss over here, will be the foreign currency translation reserve. If you have a foreign subsidiary or a branch and you're translating their financials into your own functional currency, in which case there may be differences in exchange rate which is arising merely due to translation, and as a result you will park them into foreign currency translation reserve till the time they are sold. Secondly, you will have a fair value reserve on FVOCI debt, in which case again the unrealized gains or losses on the debt investments will be taken into the OCI. And last is hedging reserve. This is specifically for a cash flow hedge, and we are waiting till the time the actual cash flow like interest, sales arise, when the balance in the hedging reserve will be transferred to the P&L account. So over here in all of these cases, invariably the standard requires you to show this as a part of a specific reserve, maybe a fair value reserve, maybe foreign currency translation reserve, maybe hedging reserve. You don't have any other choice. So when this reserve is actually realized, you are allowed to take it to the profit and loss account. So the general understanding over here is, in case of a non-reclassifiable OCI, on happening of certain events, which may be like a sale in case of a PP, or sale in case of an investment, or settlement of a liability in case of a actuarial liability, or in case of a reclassifiable reserve, sale of a foreign subsidiary, or sale of a debt investment, or receiving the cash flow for which the hedge was taken. These are specific items, and on happening of these items, the balance in the reserve, which was an other comprehensive income item, will be transferred either to retained earnings or to the statement of profit and loss. Now, the impact that you see in case of, let's say, taxes. So when you look at the presentation, it is said that other comprehensive income may be non-reclassifiable minus the income tax impact on this. So the tax impact will be taken exactly where the other comprehensive income underlying reserve is going. So if there is a deferred tax impact due to revaluation, the tax impact will be shown exactly over here. Or if there's a deferred tax impact or a current tax impact due to a fair value reserve on a bond, again the tax impact will be shown exactly over here. So you will take the tax impact exactly where the other comprehensive income is going. And sometimes the institute, when it passes journal entries, especially for deferred tax, like if there's a revaluation, they will say asset account debit to revaluation, and then there is a deferred tax on that, they will say revaluation account debit, let's say, to deferred tax liability, so that you are easily earmarking and saying that this deferred tax is to be reduced from revaluation only. Second, when you look at EPS over here, earnings per share is the net profit attributable to ordinary shareholders divided by the weighted average number of equity shares. Net profit, not the total comprehensive income, and as a result, this is before considering any OCI items. So over here, if you had a net profit of 100, then other comprehensive incomes items of, let's say, 50, your total comprehensive income comes to 150. Your EPS, both basic and diluted, will be based on 100. That is your net profit. You will not really take your other comprehensive incomes over here. And third is the disclosure and presentation. The OCI items will be disclosed and presented along with your statement of profit and loss account, and ultimately accumulated in the balance sheet as a separate line item for reserves. So this is regarding OCI, a fairly important concept in your financial reporting. I hope this concept is clear for you, and we'll meet you soon with some other interesting concepts and interesting topics. Till then, stay curious, keep studying, and good luck for your preparations.